Joe Zikas from YoChicago.com. I'm at the offices of Belgravia Group with Alan Lev, who's the CEO and president.
Yes. How are you, Joe? It's been a few years, I think, since we've had a sit down and talk.
It's actually just 1 year.
Is it 1 year? Seems
Just
like
1
seems
year.
like 2 or 3. But I'll tell you how the world has changed in the last year, let alone 2 years or 3 years. Sitting here, it's just a different real estate world.
A year ago, you were telling me that it was going to be 5 years or more before we saw any substantial condo development.
Well, I still think that you're not going to see any high-rise, big developments like our 600 Lakeshore Drive, which is 40 and 46-story buildings. I think that's still a number of years off, but we're already seeing some smaller condo development. We're involved in a CA23 project, which is at Madison and Aberdeen, and we're actually under construction on a second building, 24-unit development, which I would say a year ago I would have said, been very skeptical if you would have said we'd be putting a new condo in the ground. Special circumstances there. We'd bought the existing building from CA23 from a lender. It was half sold and half unsold, and we were quickly in 6 months able to sell the remaining units and pre-sell some units in the new building. We're to the point where we now have 10 units under contract out of 24, and believe it or not, we're able to get construction financing to build a new building. Who would have thought?
You were down to the last several dozen units at 565 Quincy the last time we talked?
We're down to 3. Three remaining, still all 3 very good units, but the last 3 which I would expect to be sold and gone very shortly.
I think you had 25 or 30 at 600 Lakeshore?
15 left.
15
so we've made great progress, and fortunately all the projects that we have, they're those 2 that you mentioned are debt free, so it's you don't have the banks breathing down our necks in order to sell these units, but we would like to sell them so we can move on to new things, and we are working on a number of new things.
I think you had also just begun 433 Briar.
Sold out.
Sold out.
Sold out. All of them closed. The last one closes in a week or 2. It worked out well. We bought this building from a bank that it was a broken condo building, and it was in a great location, Briar, just south of Belmont off of Sheridan Road. Able to buy it, price the units appropriately, put the condominium in good financial shape that it wasn't, fix things that were wrong with the building. Did a over $1 million facade renovation as part of what we did, and successfully sold the units and did well on them. Bought a couple of apartment buildings, actually broken condos buildings, but buildings that had very few units closed, up in Edgewater, another one's up in the Rogers Park neighborhood, and rented the units. The rental market is, as you've read and everyone tells you, is very strong. It's the darling of the real estate industry right now, but these buildings that we've bought and rented the units were fully occupied and operating them well.
Last time we talked about the number of high-rises that were on the drawing boards for rentals, and you suggested that, quote you, quote, several would get financing. There are 9 of them in the ground right now.
Yeah, I think there's somewhere between 4,500 and 5,000 units that look like they're going to get delivered over the next 2-3 years.
They're going to be absorbed?
I think they will. I think it becomes one of these merry-go-rounds that I think these will, but I'm not sure I want to be the last couple of guys that do the last few that get financed and may run into issues. I think they'll get absorbed. I think there'll be some rent pressure. Right now, if you're a landlord, you can get big increases. The vacancies are very low, but if you have 4,500 to 5,000 units delivered in more or less one market or 2 markets down here at those kind of numbers, I think you're going to see that the effective rents are going to have some downward pressure on them.
Is that going to put any pressure on the neighborhoods?
I don't think so. I think there will always be a differentiation between a Streeterville apartment or a River North apartment, where they're now getting high $2 a foot type of rent, $275 a foot, so they equate it to 1,000 square foot apartment renting for $2,750 a month, where you can rent in Rogers Park some places for $1 a foot, $1,000 a month. There's always going to be a need for different price points, and people will gravitate based upon their job situation, etc., as to where is the affordable place for them to be.
I was shocked when I saw what Envy
Sold for, yeah.
What was your take on that?
I'm not sure anything shocks me anymore, but big number. It's also a function of the investment situation today in the United States. These big funds are earning next to nothing on their money unless they put it out somewhere, and they're looking at a stable asset, an apartment building, and they say, well, you know, I'm getting nothing on my money, so I can buy this building at a high price. I'll put some good long-term financing on it, and I'll get a return that's, you know, 7-8%, and they're happy with it.
They're actually getting a 7-8%?
Well, I think on a levered basis, they probably are. If they bought it for a 5% cap rate, or maybe a little bit below, you know, maybe they're getting a 7% return, somewhere in that nature, and they're saying, well, I can't get that somewhere else. It doesn't work for me as a small entrepreneur. It doesn't work for me. It's an awful lot of money to tie up to make 7% on an asset that you actually have to operate. I mean, I'd buy a bond for 7% where I could put it in a drawer somewhere and not have to do anything. But we're looking, when we're doing investing, for better returns than that.
Where are you seeing the best returns today?
The apartment buildings that we're buying, we're not buying them in River North or Streeterville, so we're not buying with that type of a cap rate. We're buying them where they're distressed, where they either have work to be done or they have vacancy, or maybe there's a couple, it's a condominium where 2 units were closed, but we're buying 90% of the building. Based upon those factors, we're able to buy it at a better return, and we're making returns that are in the low teens on those type of assets on a levered basis after debt service.
You mentioned that you're looking to build quite a few units in Ravenswood.
Yeah, along with Greg Merdinger and Buzz Ruttenberg, we are working on a site north of Lawrence Avenue. It's fronts on Argyle and Ravenswood. It's right at the Metro stop, and we're in the planning department right now working on approval of 156 apartments. Now this is not a high-rise like you'll see down here. This is a walk-up, so it's more or less a series of 6 flats on a 3.5-acre site. Built out of wood and bricks and different kind of construction than the high rise you see, but with amenities. There'd be one building on this site that will have an exercise room and a community room and a roof deck. So unlike your normal neighborhood walk-up 3-flat or 6-flat, this will have some amenities for the residents. I still think there's opportunities east of Ashland in the west side, but there's also opportunities north. It depends on your product type. If you're trying to sell a condominium unit or build a condominium building, I think you got to be near north or near west. I don't think you can be further north. Lawrence Avenue, for example, we didn't even entertain the idea of building for sale product up there. Now, something else to talk about is we have a contract on a site up in Lincoln Park on Montana between Greenview and Ashland. And it was an old industrial site, and it's now vacant, and it's rezoned for residential, and we are in the process of finishing up the approvals necessary to build 14 row homes. And I want to distinguish a row home from a townhome. When I say row home, what we'll have here is 14 25-foot lots with a 25-foot house on it. So you won't have that debris collecting gangway in between 2 single-family homes, because they won't have a separate wall. They'll have one party wall between the units, but that allows, instead of your typical single-family home with a 19-foot wide house, this will be 25 feet wide, front yard, 15-foot front yard, your house, and you'll have about a 45-foot backyard, and then a detached garage in the back, and we'll be selling these homes in the $900,000 range.
And you have Papa George James doing the architecture?
We have Papa George James doing the architecture.
Have a lot of experience in the luxury market up in that part of the woods.
Absolutely. So this spring we'll be kicking that off.
This morning I heard that National Association of Home Builders reported that builders are feeling more bullish about the market than at any time in the past 4.5 years.
Not surprised.
Are you seeing that among Chicago builders?
I do. Both city, Chicago, and suburban. The number of developers is far lower than at its height. Unfortunately, a lot of my cohorts are gone. They're just not in the business, and the same holds true in the suburbs. There are very few suburban builders yet around, but the ones that are around are starting to have an uptick in activity.
What are the ones doing who've moved on?
Some are totally out of the real estate business. some are back practicing law, some are working for other people in other industries. It really shook out quite a bit.
What kind of advice would you be giving buyers today? A lot of them are skittish about the market.
Well, I think we've hit the bottom. I mean, certainly in the city, I think we've hit the bottom. There's still foreclosures on the market. There's still some inventory out there, but not nearly as much inventory as there was a year ago, 2 years ago, 3 years ago. The dynamics of owning versus renting has shifted. It's now, by and large, more expensive to rent than it is to own on a monthly, basis on your outflow, which does make sense. In my view, if you want the flexibility of being able to pick up and leave from somewhere after a year and make a short-term commitment somewhere, you should be paying for that luxury. And that's really now what's been priced into the market. We've seen a little bit of uptick in jobs here in the Chicago area. I think when we start to see a little bit more of that, and there's a little bit of a track record of price stability, I think you'll see some more people come into the for sale market. I don't think we're going to be back to the days of 69% owner occupied homes. I think we're going to be at a lower percentage. And I think that's probably what we're going to see for years to come. I think you'll see more renters and less home buyers.
You mentioned the Marcus and Millichap report. When I walked in, they're looking at a 4.2 vacancy in the overall Chicago market, which is a low vacancy rate.
Yeah, sounds right. I mean, we're generally still projecting 5% or so on our projects, but I think you're going to see a sub 5% vacancy rate for the next few years.
They were also looking at, I think, a 4.8% increase in effective rents.
Yeah, I don't think that's
for next year.
I can believe that for the next year. That's not a sustainable rate any more than the value of homes that went up like they did is sustainable. But I could see that for this year. But I'm thinking you're going to see more of 2 to 3% increases going forward.
Alan, thank you.
My pleasure as always.